The following video is for entertainment use only and should not be considered financial advice. Please do your own research. Hello guys, a very Merry Christmas and a Happy New Year. This month's video is going to be slightly longer than normal. I'm going to do my December portfolio review and the dividends that I got, and then we'll do a quick overview of the year and how it went, and then my strategy, well, my plans for the upcoming year. So starting with this month, we started off the month putting my money in at 6.5, and we're at 6.5 and a little bit. So made a little bit of money. Bit of turbulent month. It went up quite nicely. And we had a big lull in the middle, and then a little bit of recovery towards the end, and then a little bit more of a slump. So not great. Top 10 hasn't really changed. General Dynamics have come up a little bit. I've had a bit of a better month. We'll do a quick scroll through on my holdings. So if you want to see any particular one, then please pause the video. But they're some of it's good news, some of it's not. Can't be helped. It's the way the world at the moment. 2022 has been a very turbulent year, with tech stocks taking a big hit. Energy companies doing, some doing well, some not doing so well, but generally a fairly static year. Mainly my ETFs done okay, but they're the market, shall we say? I don't know how else to say that really. Like I say, like tech stocks taking a big hit. And the global supply chain, some of the other ones take a big hit as well. REITs have doing okay. I mean, I was expecting them not to do okay. Mining's been okay. Rolls-Royce turned a profit by the end of the year. That's more through cost averaging rather than share price growth. Because, like I say, bought them in January. It was up here at quite a low, and they started to recover. But because of cost average during the year, I'm actually turning a profit on them. Apart from that, bank and finance has been doing okay, but high interest rates have helped that. But yeah, what a year. Seems like a very long year. So that's my companies. If you want to see anything, please pause the video. That's my month for December. Over the year, quick review in the year. That's where we started at just over 3k when I was getting the portfolio set up in the first year. Returns of £331, and then haven't actually been negative this year as a total, should I say, but on the year investment I had been. And then we finished the year at 9.5%, so £570. So going in the right direction, not lost any money. That's where we're at. Okay, so we'll flick over to the dividends for the year, for the month, sorry, and then review the year. So 3M paid out 69p, which is okay. Amflac paid out 54p, which is still a good growth up on the previous payment. AG Investments paid out slightly less than the previous month, but overall for the year, my payments have more than doubled, so happy with it. Arch and Daniels paid out up on the previous payment, which is good. BAE Systems paid out 27p, which is okay. I only bought that sort of first quarter-ish, so did okay for them. First some oils, BP paid out less than last time. Bit disappointing that, actually. They've made quite a large profit. I was expecting more returns to shareholders, but they haven't done that as of yet. Next oil one paid out, which was a profit on the low. Profit was higher than the previous time. So okay, that's Chevron. Coca-Cola paid out, which is good. Emerson Electric, that's a US energy firm, paid out again up. Just happy. One of my monthly ones, I started off in the middle of the year, doing really well actually. I'm going to be increasing my holdings in that this next coming year to sort of fall in line with my dividend strategy. IBM, sort of bucking the trend for technologies. They're actually doing okay. I've got 96 pence for them, nearly at £1, which is really good. So in 2023, I want to start seeing some more pounds a month rather than pence. I want to see that transition. First, my ETFs paid out 39 pence. Happy with that. Another one of my ETFs paid out. Well, I bought this. I had big hopes for it, but it hasn't. It's been really stagnant. So not doing as well as I wanted to. But I didn't do it for the money. I did it for my beliefs. Really, I believe that these companies can, in this ETF, can make a change to the world. So hopefully in the future, I'll start seeing that financially. Another ETF paid out 33 pence. So happy with that. Sainsbury's paid out 63 pence, the final one. First year of owning those, did actually okay, I think. Quite happy with that. Johnson & Johnson's, one of my staples, 51 pence, that's up, which is good. Main Street Capital, that's a REIT ETF, a REIT holding that pays out monthly, doing okay. McDonald's paid out, everybody's favourite meal apparently, but did okay, so I'm happy with that. Microsoft, tech's taken a big hit, but it's a growth dividend stock. I've got belief in it in the future, and hopefully that will start growing over time. Another ETF paid out 35 pence. It's a bit average for what it's been paying me out, really. Not exciting, not shit. PPG Industries paid me out as well. Did okay. Prospect Capital, one of my another ETF, another monthly payer one, fairly stagnant over the last 3 months. That's a sign of 2023, I think. Reality Income and another REIT. That's, like I mentioned before, REITs are not doing okay compared to what I thought they was going to fall a little bit this year. Shell, my other oil company, same payment as before, doing okay. Sherwin Williams paid out 15 pence, that's doing okay. And DAG, that was my best performer last year, it's been fairly sort of stagnant this year, no real growth, but not really cutting the dividends, so that's doing okay. Unilever, strong actually compared to what I thought it was going to do. Well, I thought this year was going to be quite turbulent, which has been, but things like Unilever, when times are hard, they do a lot of brands, showing a good buy actually, I think. Nearly the end, my Vanguard UK Gilt, which is government bonds, performed poorly this year, as expected, I suppose. We're going down now. We've got next WW Granger, doing okay. And lastly, Whitestone REIT, that's been fairly steady throughout the year as well. So overall, I got £16.64 for the month, and that's not quite the end of the month yet. That might go up as more dividends may come in, but with the bank holidays, I'm not expecting it. So doing okay. So that's all right. over to let's do the charts. I don't know why I don't just use my mouse. Sometimes I can be quite lazy. Let's make it a little bit smaller so you can get it all on one screen. So this chart shows the dividends paid out by all my companies I've got. They've all paid me a dividend now, the ones I've got in. The biggest one being BP. The next biggest one is Penning Group. Number 3 on the list is Shell. Number 4 is Aviva, but they returned some capital. And then 5th place sort of tie with AGNC Investments and Prospect Capital. So overall, you can see they're all off the mark. Some are paying more than others. So again, if you're looking at starting your own portfolio or some common, this is just really a guide of what they pay. Generally, it's just a big overview of their yield, really, and how much they return to their investors. Doesn't mean to say that BP is a good investment. It just means it returns more than Microsoft, which returns very little. Month on month though, nice trends. So we started off at the beginning of the year at £5.50 a month, and we've ended the year at £16.64. So it's nice to see that trend going forward. So for the numbers, so this month in the ISA, I'd stuck in 200 quid, and that returned me £13.42 in interest and gave me a balance of 5,663. So let's see how that compares to my investment side of things. So as a comparison, I got £16.64 dividends, so £3 more this month than I did interest, so that's good. And my investment value stands at about 6,000. I put that in the other day, it's gone down slightly now, but still about £1,000 up. Yeah, about £1,000 up. So I'm actually £1,000 better off investing than I have been putting in an ISA. Cash ISA, that is. Anyway, so I finished the year on capital growth with the dividends included at 6.63%, which is not bad. Sort of target 7%, so a little bit less than that. But I'm happy with it. Total year's dividends was £154. What did I get in interest? Just out of curiosity. Did I do that here? Some £59. So really pleased with that. My dividend yield is 3.56%, which is about right. That's where I targeted. So next year, going into plans for next year, I sort of want to target that closer to 5. So the way I'm going to invest my money is going to change slightly. I'm going to invest more in some other holdings than others, just to try and boost that up. So since I've started this, now I've got £205 in dividends. That's just £205 of free money. I averaged £12.84 a month in dividends, which is good. And I actually grew the money I put in, which was £3,000. The actual capital growth on that was £213, so not too bad. And I did manage the £250 a month average deposit, which I wanted to do. So next year, I want to try and average £300. That's going to be a very difficult challenge because cost of living. I've got some DIY projects I want to complete this next coming year. So looks at my finances and what I can realistically afford, and I think I will be depositing £200 a month cash from my earnings, shall we say. But periodic points throughout the year, I'm going to be moving some of my dividend returns from other portfolios into here, trying to make the gap up. So I'm going to try and maintain that. But we'll see how the year goes. So I'm not sort of making any real concrete plans. I know what I want to be. I'm just don't know if I'm going to get there or not. So let's have a look at my dividend charts. So looking at the year as a whole, I put in 3,000. I earned £154 in dividends. I got £213 of capital growth, which left me over 6,600 at the end of the year, which was good. This is my dividend growth since I started, and it's all going in a nice upward trend. So this is the exponential line. So as close to this line as I can get is doing well. Or sorry, above this line is doing better than I expected. Below this line is not doing as well, but as long as they trend along that line, we're doing okay. So for my predictions, how did I do for the end of the year? So I predicted that I would get £105 in dividends, which I beat that because I got 154. I did predict that I'd get £651 in capital growth, which I didn't. I only got 213, so disappointing. And my fund value was predicted, I think with calculating error, at nearly 10,000. So that's where we're at. So am I going to make the 50k in 5 years? No, it's still gone back to 13 years at the moment. But so going into when I go into 2023 and I start getting the sheet money for that, I will be doing the average growth. So because now I've got 2 years worth of data, I'll do an average of that growth, then try and see what that gets me out. So overall, not too bad. The year as a whole has been a profitable year, which is always a plus, but not as expected. So, and 2023 is going to be another challenging year, and I expect things to start moving forward again in 2024, maybe 2025. So, still a long way to go. So, going back to what I'm going to be doing in 2023. So, I've organised my pies now in a slightly different way. It took me a little while to do that. So the first things first is I want to get to a yield of 5%. So I've put my highest yielding companies into one pie and then everything else into another pie. So I'm going to share these pies if anybody's interested. One thing to note though, if you look, I've got the most amount of money in my 5.5% dividend yield, but the returns is quite low. And in my lower yield, my capital returns are quite high. So it's something to consider when you're doing that. I've also created a hold to sell pie. So for companies that I want to sell or are looking forward to selling, are in this pie, and I still invest in that. So on the labels is how much I'm going to put in per company per month. So this pie will have £1.50 per company. This pie will have £2 per company, and this pie will have £1 per company, and then my value pie is £5 per company. So if I'm selling them while I'm investing in them, well, a lot of these companies are at a loss, and when they get to, let's say, a 5% return, then I will sell them. So currently in there is Sergo of the iShares FTSE 100 ETF, because I've somehow managed to get a Vanguard one and iShare one going at the same time. I'm not sure I did that, so I'm going to be selling that. And 3M. So I'm selling Sergo because it's my most disappointing buy. I thought it was going to do really well, and is yet to do that. I thought, because they're a warehouse, they rent warehouses out in the UK, etc. And the way sort of things were going, warehousing was doing really well, but with the global supply chain, that's take a bit of a knock. So, and the dividend returns is not that great either. And I've just sort of decided, well, enough's enough. I'm going to sell it. So I still put £1 in there, so I can still use my cost average to get that profit back up, to try and get it into a profit, shall we say. The FTSE 1, that's already at 6% profit, so that'll probably get sold in the next month or so, as long as it stays up there. And then that money will then get reinvested back into the whole portfolio. 3M, I've decided to sell those because they're at a high risk of cutting their dividend. They've got a number of lawsuits against them over earplugs and some bond and stuff, and well, they're in a bit of a mess at the moment. But that doesn't mean to say they're a bad company. It's just that they're at a high risk of cutting their dividend totally, and so it's not fitting into my strategy anymore if they do that. So I'm going to cost average into that. So put my pound in there, try and get this 20% loss to 5% gain, then I'll probably end up selling them. But that may change if time tells a different story and they sort the lawsuits out and they don't cut dividend. I might end up keeping them. But again, at the moment they're on my sell list, so that's why they're in this pie. And obviously then I've got my value pie. These are just companies that I think will grow. They don't pay dividend, but I think they'll grow. And I added them because I thought it was the right time to buy. So Amazon did a share split, and they said they actually come down to a reasonable price to buy. Tesla, the hype over the last couple of years has sort of died down a little bit. They've done a number of share splits, and their share price has come to a reasonable amount of money to buy into, and they're running about just over $120, I think, at the moment. And I think their ceiling, what I think they will peak at is around $300 long term. So again, I think they're a good buy at the moment, so I'll just keep putting the money in there. Meta platforms, when they changed it to Meta and the Meta universe and stuff and all this other good stuff, I think it has got, it's not worked out quite well at the moment. They're quite a loss for it, but I think future growth, I think it will take off. I just think they've got a strategy slightly wrong about it at the moment, but I think they'll turn it around. So that's Facebook and stuff. For those who don't know what that is, so again, I think that will be a profitable one. Google, Class A, Class B, Class C. You can't really buy Class C, I think, but the A and B, there's not really much difference. So I'll just pick Class A. Again, they do a lot of good stuff, and their share price had a bit of a dip, and I think they had a split as well. So again, I thought it was the right time to buy into those. And then Rolls-Royce, because my late father, that was one of his favourite companies. He had a lot of money invested in those. He had a real hard time through the pandemic and made a loss. But then they've got quite a lot of products in the pipeline, say the modular nuclear reactors, their space program, and their domestic, aviation, aerospace industry. And I think that's going to pick back up now. The COVID's sort of gone, but the fuel prices are high and stuff, so their growth returns going to take a little bit longer than I thought. But again, I still think it's a good company to invest in, so that's why they're in there. So going back to my strategy for next year, I'm going to be trying to increase my yield. So all these companies here pay above 3%, I think, as a yield. Some pay more than others. So what I'm going to be doing, it all needs a bit of a balance because it's not very balanced at the moment. It's all over the place. So I'm going to be manually balancing rather than using the Train 2 and 2 balancing section. So once I've put my £100 in there, that's about £50, and that's about £30, obviously about £5 in there. So with £200, I'm left with a little bit of surplus cash. I'm going to be doing a bit of manually balancing. So, for instance, BAE Systems will probably be one of them. The first ones will be where I put an extra £10 in there to try and balance it up and reduce. That will then in turn start reducing some of these, so it'll still balance out. That's what I'm going to be doing with that. And the other thing I'm going to be doing is manually also adding to them some of the higher yields, because I want because I don't think capital growth is going to do very well next year, and I am doing this as a dividend strategy. So things like Prospect Capital, AG&C Investments, Horizon Finance Technologies, stuff like that. Big yield payers. I'm going to be manually adding to those to increase those. So that will take them above the 2% limit I sort of set, but that's just to make it even. So my plan would be to get that to over £1 a month, because I think I need that to make the dividend predictions for next year, because it's going to be around £300. So I do need to do something slightly different to make sure I get that. And I'm probably going to be adding some more renewable or some more energy stuff. So yeah, it's going to be renewables. There's two companies I'm sort of looking at. I'm going to have around about 5% yield as well. So that's why they're sort of looking at them. But generally, that's what I'm going to be doing. I'm just manually balancing this pie out. In terms of this pie is fairly balanced, but again, there is a little bit of balance that needs to be done in there for the stuff that I added like middle of the year. I'll be doing the same for those. So I will share these pies when I work out how to do it. Can't remember how to do it at the moment. And then I'll put a link to them in the description for these videos if you want to copy these pies at all, or in general, if you just wanted to pick some of the better performing holdings, because that's what this is about. This portfolio is about showing what returns you can get from holdings rather than, it's an experiment. So if you want to pick the top 10, for example, your ones you like, then by all means do that. I mean, an ideal portfolio would have sort of between 5 and 20 holdings in it, and not as many as I have, because the more holdings you have, the more difficult it becomes to manage. And I really am sort of doing this portfolio as an experiment rather than my main portfolio that I do through Hard Cruise and Lowdown, which has got 7 companies in it. Anyway, so I hope you've enjoyed this video. I'm looking forward to a prosperous new year, and I hope you are too. And if you've really liked this video, please give it a like. It really does help my channel out. And I'll sign off with that. Thanks, guys. See you in the new year.